If you crave suspense, the build-up to Japan's June 2017 company AGM season is like a 1930s horror film, with analysts as rabble-rousers urging the march on the castle and investors as once peaceable yokels furiously reaching for their pitchforks. Japan has plenty of market monsters overdue a slaying. A third of companies in the Topics Index have 5-year return on equity ratios below 5%. Around 440 companies have takeover defence measures in place. Cash is being hoarded without justification, and shareholders have a long tradition of approving the re-election of managements doing all of these. But this year, say the analysts, it may all be different. Citigroup strategists suggest the AGM season could confirm revolutionary changes in relations between investors and companies. His counterpart at CLSA envisages a flame under the corporate governance story. Both analysts and several others argue that 2017 invites the real prospect that investors will grip their destiny and defenestrate underperforming CEOs. Various screens, including presidents with approval ratings that fell last year and companies with high activist ownership ratios, are used to identify the most likely victims. The head of Kawasaki Kisen, a shipping company, tops most lists. Investors, meanwhile, look more empowered than ever. The 2014 Stewardship Code has been updated to pressure institutions into disclosing their voting. Institutions have formally published their criteria for opposing AGM resolutions, and the Tokyo Stock Exchange is exploring systems that would allow far greater scrutiny of managements. Symbolically, and for the first time in many decades, the percentage of companies holding their AGMs on the peak day, in this case June 29th, has fallen below 30%. Still quite a concentration, but certainly heading in the right direction. Of course, the chance remains high that the mob either tires halfway up the hill or scarpers when the monster answers the door. But companies can no longer rely on that, and brokers are coming up with ways to play the uncertainty. Citigroup suggests screening for cash-rich firms that have not conducted buybacks or hiked dividends since April 2016. A list, effectively, of the companies with the most to fear from shareholders, the most urgent need to smooth their AGMs, and the most to gain from announcing a tactical quick fix to improve shareholder returns.